Trading is a game, and like any game, there are levels to it. 9 levels to be exact. Each level determines how much money you can make, what percentage returns are even possible, and who you're competing against at that tier. Most traders don't realize that they're actually playing a much higher level than they expected, without mastering the foundational levels that actually pay the bills month after month. In today's episode, after 14 years of playing this game across nearly every level, we're exposing the complete hierarchy. We'll discuss level 1, which is basic trend following, which still works despite everyone knowing about it, and what level 8 and level 9 looks like. You'll know exactly which levels you're actually playing at and which levels you should maybe target next. So let's play this episode. And we're going to give you our opinions on what is possible, what you could aim for, and just even expose you to new ideas you could maybe try it out in the future. First off, I'm going to hand it over to Pedma. He can explain the basics of level 1, which is trend following.
Not to say that it is a very basic idea, because it's not, and it has its own complexities, but the very first simple thing that people usually try, that is a basic risk premium, is trend following, right? You buy stuff that is going up, and that has, and it usually has a tendency to go up, and you buy stuff that is going down, and that usually shows a tendency to continue to go down. There's a bunch of lines of thought on why this happens, right? I don't want to speculate on what it is, but you can imagine that there's some confluence between behavioral effects, hedging effects, whatever. The reality is that if you measure that, it's a clear edge, and we talk about it a lot on these episodes, that we trade it, and we do that, and that's the initial. I think one of the first edges that it's easiest to implement, that is very hard to do wrong, and yeah, that's the first level.
Just for anyone that's not too sure of the word risk premium, I'll just quickly explain it. Primarily, what it means, very simply put, is you're getting paid for taking on risk. And some people may not understand that instinctively when you're trading, right? Because you might be thinking, well, I'm actually trading based on an entry signal or something like that. But the underlying part of that is you're getting paid because you're taking on X amount of risk. And normally, for example, in trend following, you're taking on more risk by putting your capital in equities or whatever market, right, that you're going long on or even going short on if it's trend following, compared to a risk-free rate. So let's say if it was in your savings account, if it was into bonds, etc. So you deserve at some point to get paid for that amount of risk that you're taking on. Otherwise, people would never touch these things, right? So that's the kind of basic idea of it. Now, there are multiple types of risk premium. I don't think we have time to go through all of them, but the main ones really is like you got mean reversion, you got trend following, and you got carry. And kind of leading on from where Pedmo went off with it is that you've got the basic models of all of these. These have been around for decades. You can easily look up online, hey, give me a basic trend following strategy, and something like you'll probably see like a moving average crossover or price crossing over a moving average. Now, a lot of people will tell you, well, that's way too simple to work, right? Everyone's found that it's been obbed away, it no longer works. That's not true. The reason being is because overall, the past 10 years, 20 years, markets have trended upwards. So if you have a very nice and simple entry signal and you aren't applying it on a highly noise kind of time frame, like the 1 minute time frame, etc., and you're applying this maybe on a daily or weekly time frame, you will 100% make some money over the long run by just going long on different types of equities, etc., based on those sort of signals. Now, the reason why this is like level 1, level 2 is because it's very basic, right? You're not going to be able to really outperform the market by that much. You could maybe outperform it if you're using some more leverage or if you refine these, as we'll get into on the next levels. But this is the very basic starting point, at least for kind of trading strategies.
Yeah, for sure. And you can, you made that a very good point about why are these edges not arbitraged away already, because everyone knows about them, because there's some risks about it, right? That's why it's called a risk premium, because there's a premium to be paid on that risk that other people are not willing to take. Why is it there still? Because it's a edge that sucks, right? That is hard to do, that is hard to sustain, to maintain through drawdowns, whatever, through the irregularity of the edge, all the operational stuff that you have to do on the back end, but it's there. It's still there because someone else was not willing to completely arbitrage it away. And you can take, and if you are willing to take that risk, that's a very easy form of edge to start extracting. It will be hard to do, like I said, but it's an initial step. And if I may move to the third point, the third point is doing that risk premium, but on less efficient markets. So you take that concept and then you go a level deeper. So you have these risk premium models that you are taking risks that others don't want, even if they are known, like the trend, mean reversion, carry, whatever. And you take those models and you apply them to a new riskier market, for example, crypto or other markets that you see, like Indian equities or other hot markets that is out there, that it's not just traditional US equities or commodities. And you take those same strategies and you move there. Again, you are taking more risk than other people, so you should expect, or you should want to get paid more for that. And you move to another market, it brings its own idiosyncrasies, its own uniqueness of that market, and you need to control those risks. And so that's step number 2.
Perfect. And then level 3 would be kind of volatility targeted. So primarily what that means is that you are only taking on X amount of percentage of volatility for that particular model. You can also then kind of venture into delta neutral models, which primarily means you're market neutral. So you're not necessarily going more long than going more short on that particular portfolio, and you're kind of arbing the difference of that, of the returns. If you want, Pema, do you want to kind of give an example? Because we actually covered a recent example in the group.
Yeah, sure. So on the volatility targeted, you can be delta neutral, but you can also be directional. There's both ideas, but one of the, like you just said, that you have been working on a lot is the delta neutral type approach. So in a market neutral approach, you try that to always be long and short the same amount of exposure that you're trying to neutralize for. Let's keep it simple and let's say it's a market neutral model. You don't want to be dependent, or you don't have to have the directionality risk of that market. So if let's say that we are trading crypto and crypto is highly correlated to BTC, let's make those assumptions, and you don't want to be dependent of if crypto goes up or if crypto goes down, and your portfolio goes up or goes down with that. You want a beta very close to zero, so you neutralize both legs, both the long and the short, to that market exposure. And once you do that, you keep a market exposure usually near zero. This means that you have to trade more times because you have always to be rebalancing your portfolio back to a target that keeps those legs neutralized. So every day, every hour, at certain thresholds, when that action is positive value after fees, and you keep those legs neutralized. Now, this adds a lot of this adds more complexity to the models. That's why it's a level up from what we're talking about, but it's something that is very attractive to do.
Yeah, and just to be clear, if anyone's wondering, because I know this can get more confusing, is this is still a risk premium. So you'll kind of think about it as you're like fine tuning a car, right? Like you have a basic level car, but there are some things you can do to it to get it faster, to make it run better, etc. And volatility targeting is just one of those extra levels that makes it a level 3. Now, to make it a level 4 type of kind of strategy is where we get more complex, but we're still dealing with risk premium, but we're doing something called continuous. So primarily, you've got 2 ways of executing and trading. You've got binary and you've got continuous. Binary is like an on-off switch. So you're either going long or you're taking off the whole position, or you're going short or you're taking off the position. Just kind of flipping that light switch on or off. Then continuous is where that is a range. So you'll normally have it neutral, meaning you have -1 to 1, for example, and -1 would mean you're fully short, and 1 would mean you're going fully long. But all those numbers in between would be a different amount of position size that you're going either long or you're going short, for example. So let's say we got a signal and it was 0.5. That would mean we're going half long. So we're not going a full position long, which would be 1, or we're not fully allocated to the long side where it is 0.5. Now, you may be thinking, like, why is this possible, or why is this even worth it? Primarily, it's because most signals aren't ever actually have such a high conviction that you should be fully long or fully short at that moment. Most of the time, that is constantly changing because you're getting new information, you're getting new signal information. Depending on how you're crafting those signals, maybe you're getting multiple different indicators that are giving you, a different signal. So let's say we had 5 indicators. 3 of the 5 indicators are saying go long and 2 of them are going short. Well, that's clearly telling us that we don't want to be fully long, but we are more biased on long. So we'll go maybe 0.4, 0.5, etc. Whereas if all 5 indicators were saying 1, then we'd want to go fully long on that particular portfolio. That's a very simple way of explaining it. There are more kind of complexities with it, especially because if you're thinking about this, the more you're doing a continuous model, the more transactions you're doing, meaning you're going to have higher commissions. Now, in particular markets, that may not be worth it, or in very high commission markets, that's definitely not viable. But in other markets, or depending on when you're rebalancing, so let's say if you're doing it on a daily or an hourly, etc., then those commissions may not be as much of a big deal, and it's still worth it to do continuous. Normally, for this level, this is kind of the pinnacle for most of risk premiums, meaning it is the best way to do mean reversion. It's the best way really to do trend following, etc. Just because you will normally get the highest return possible, or you'll get the most efficient returns possible with that. So that will normally be based on Sharpe ratio or like Kager as well.
Yeah, and now we move to level number 5. What we consider level 5 is seasonality type trades. For example, we put it at level 5 because they are a bit more prone, in my opinion, to an overfit. Because people will, if I trade on Wednesdays at 4 p.m., I get whatever. That is very prone to overfit if you don't have a very strong explanation for them. For example, at the end of the month, we know that funds and pension funds and whatever tend to do monthly rebalances, right? And you can see that people, when they tend to rebalance, they buy more of the losers, because the losers, for example, on equities, the losing stocks lost value, so we have to buy them back up to bring the portfolio allocation to them back to target. And the strong winners, they are sold into because the portfolio on those legs grew a lot more. And so you have to sell them to bring them back to a target allocation to the portfolio. Because most portfolios want to keep things in balance, right? So if you have something that goes up a lot, you sell, and if you have something that goes down a lot, you buy more of it. And when you put together that a lot of these funds and big players do this at the end of the month or at the end of the day, whatever, you start to understand, you start to see some of these rebalancing effects at the end of the month, right? And then when you put it together, you see that I can buy a few days before the end of the month and profit there from these rebalancing effects. For example, go short the strongest equities and go long the weakest equities, and you can see an effect there of an end of month rebalancing. And those are seasonality type trades. Or you see that during Christmas there's an increase in activity in markets or a decrease or whatever, and you can make also reasonable assumptions there. Those are seasonality because they happen a few times a year, a few times a month, whatever. And yeah, they are seasonal.
Pretty much perfect. Was there anything you wanted to add on top of that or no?
No, those are pretty, I think, pretty standard. Yeah, it's just calendar type trades.
Yeah, most of the time you can slightly optimize them, and also they'll normally be different on depending on what the market is. But you'll often be able to find a decent edge around those. The next level, which is level 6, is event driven. So this is normally around anything that is like earnings, news, Fed announcements, etc. Now these can get quite competitive, meaning that let's say you've got a new filing came out for a particular ticker and there is an action that is being taken on that ticker based on that filing. There'll normally already be algos out there that are kind of scraping that particular filing or finding some way to go through that filing and see what direction they should be trading that stock on based on that new news. However, there are still ways for most people to capitalize on it, and it's also one of the places where if you can find a way to capitalize, it often can be quite high returns, primarily just because normally things that are around event driven normally have quite a lot of volatility, meaning that if you do have a high win rate or you're able to do a good reaction to it as fast as possible, you can often capture quite a big meat of the move. A classic example that isn't as high returns, but it's still technically in the event-driven thing, is normally earnings drift. Normally that means after a positive earnings, normally that stock will drift upwards for X amount of time. This depends on the particular sector, and you'll have to kind of do your own backtest to see how long that drift lasts. But that is something that can definitely still be profitable. It is a bit of a boring strategy. Also, you don't get that many opportunities because it just depends on how profitable earnings are in that time, and also how big of a surprise it was, and then how much that drift is going to be actually led from those earnings. But probably the most classic ones are around news as well. So let's say surprise news come out based on a ticker, like recently the Trump deal that came out with NVIDIA, that he allowed NVIDIA to sell chips to China, and then all of the sudden there was new news that China blocked the selling of NVIDIA like GPUs in China, that sort of stuff. There's a lot of algos trading on that sort of news because a lot of that was surprise and also unexpected, meaning you could do quite a lot of volatility based on that. But it's still a really good strategy type, just is quite competitive. So you'll have to either find a niche where you can take advantage of it, or you have to go quite large scale to actually do it.
Agreed. And for step or the level number 7 is arbitrage, right? These ones are higher in the level range because they are really hard to maintain. Once you find them, okay, you have an arbitrage now to do. Maybe you have them for a day, maybe you have them for 6 months, but you don't really know, right? Because if you have like, okay, you can sell on you can buy on one exchange or whatever, like 10% lower, 5% lower than on exchange B. Like a lot of people will start seeing that, and you'll soon be out of edge, right? So arbitrage, you need to be very operationally ready to extract them. So you need to have at least to always be scanning for opportunities. Because if you don't have data, you cannot know where there's fragmentations or there's inefficiencies going on right now. And then once you find one, okay, you start harvesting, but then you need to move on to the next one right away. You have to always be catching up to the next one. Otherwise, you're going to stay out of edge. But when you find those, these are really good trades because usually it's guaranteed, not guaranteed, there's risks involved, of course, but there's almost guaranteed profit because you have something cheaper on one side or more expensive and vice versa on the other. And you can capture that return relatively simply, but you just have to be doing it a long time. It's very short-lived type of edges.
Yeah, completely agree. Arbitrage is like one of those ones where when you do find them, you have to maximize them as much as possible. Just because most of the time they just don't last. Now the next level, which is level 8, so we just got one more level to go after this, and these are kind of niche alpha strategies. So primarily this is something that is actually alpha, so you're not getting it based on risk premium or volatility, etc. You're not getting paid for any risk. Most of the time these are an actual inefficiency, so something that you have spotted or someone is making a mistake and you can take advantage of. One example that it's hard to fully say how much alpha this purely is, but I definitely would say in the early days, like small caps in equities was quite a lot of alpha in the sense where you could short a lot of these fake news listings that would push up the stock by X amount of percent, and you could short it and then make a very good return on those. Similarly, you can also do it in like crypto, where there was new listings that were being listed on Binance. I would probably say after 2 days of listing on Binance, most of the time you could short that, and then it would normally fade lower for the next like 10 to 30 days, give or take. Obviously, still backtest all of these sort of things, but this is primarily where someone is even making a mistake, whether that be retail, whether that be institution, etc., and then you're able to take advantage of it. It can also be exchange mistakes. Now, this would normally be slightly referenced into like arbitrage, at least the most time for like exchange mistakes, but sometimes they can be something where you can take advantage of a certain protocol or certain thing an exchange is doing, and you can make money on that. Similarly, this I don't know if you necessarily put this as 8, but like polymarket, like there's a lot of necessary gray area right now about what information is insider, what information is not, etc. So there's a lot of people that are able to find out whether by whatever means new information that they can then better price that particular bet on polymarket. And that would still technically be counted as someone as alpha. Obviously the gray area there is quite huge, but that would definitely be one for level 8.
Yeah, for sure. And it's like the arbitrage level, right? You have to always be seeking out new sources.
Yeah, completely. All of these alphas either degrade, meaning they will still work, but they will be working a lot less, or they will fully stop working. I will say, at least from my experience, normally for niche alpha strategies, they will normally degrade. I've never really seen them fully, completely stop working like instantly. That's normally more around arbitrage, where arbitrage just like suddenly stops one day and you just can't really arbit anymore, or it doesn't make sense to because like commissions are too high or whatever. Still kind of works, but it's a lot less than what it used to be. But it still is a very good strategy compared to a lot of other strategies like lower on the list, right? So it still could make sense to put in your portfolio and still run, for example.
Yeah, when you say we have to be looking taken out at capacity, but for niche alpha strategies, it doesn't mean that they stop making money. What they're stopping is alpha strategies. They start paying risk premium. Risk premium is yesterday's alpha. I saw someone say that and I really like it. Like risk premium is yesterday's alpha. Like trend following was at one time alpha. Okay. momentum was at one time alpha. But then in the 80s or 90s or whatever, they started writing papers on it. They stopped being alpha, right? It's everybody knows about them. Yesterday's alpha, today's risk premium is yesterday's alpha, and there's no way around that. So it's not that they stop making money, it's that they stop being alpha strategy and producing the type of returns that are idiosyncratic to whatever you have on the portfolio right now. In the last step is number 9, the last level. And this is one that I'll not comment much on it because I really don't have the experience in it to make any meaningful comment, but I still think it is nice to include them. And it is market making and HFT type strategies where you are trading sometimes sensitive to microseconds or milliseconds or whatever the latency that you need to be specific about. And this is really where like the big brains go to go to compete, right? And it's not somewhere I compete at.
Yeah, completely. This is where like market making is the reason why it's level 9 is because in market making strategies you could have a very high Sharpe ratio and you could be making money every single day, and if you actually lost money for the month or something like that, it would be quite absurd, or your market making is not very good.
Yeah,
But that is only a factor because it is so competitive. You have to be quite smart to actually do it. You have to have very good tech to be able to do it. Now there are niches, right? Like when meme coins were around, while they were getting started, you could actually do your own sort of HFT, right, on meme coins, and you would probably do quite a nice profit. However, that was quickly kind of taken away when meme coins ramped up, and then all the other kind of current crypto market making firms kind of went into it and started doing their own stuff on it and would primarily eat your profit. So it is incredibly competitive, incredibly hard to do. I wouldn't recommend it really for anyone that's trying to just get started or anything like that. But that is at least good to know of where you are on the level system of trading strategies. I think we've kind of
exactly.
gone through all the main ones we've ever either heard about, seen, or actually traded ourselves. Primarily, at least for Pedro and me, we primarily focus on 1 to 6, give or take, maybe 1 to 7 sometimes, like sometimes an arbitrage here and there. I did have the small cap stuff back in the day for 8 on niche with like niche kind of alpha strategies, but I do think for the majority of our portfolios, they're normally in the 1 to 5 or 4 range, give or take, for levels.
Yeah, for sure. We are venturing way more outside of that, and we are actually going a lot on the alpha strategies as well as of late. But yeah, I would say that our majority of location is between those first group. And yeah, like the number 9, like market making in the HFT, it's not to say that it is impossible. It's just say that the people that are good on doing that usually work at firms or are very good technically in both trading and like development IT. So it's a very hard place to compete. If people don't have a formal background in trading and didn't work at the firm to do that, I don't think that's a viable thing to start doing right off the bat. I said there's a lot more low hanging fruit that people can be harvesting that is much easier to do and put on than go for the most difficult edges. But of course, this is anecdotal. I think it's how you say it. But I know from very reputable sources of market making and HFT traders that counts the weeks that they lost over the past few years. Okay, that they were red. So when you have those, but I also know that they have to be upgrading their edge like almost every 2 weeks or 3 weeks or whatever to remain relevant. And it's not edges like, I'm going to change the EMA crossover this month. It's not that, right? And so those are very hard places to compete, but the hardest it is to compete or the riskiest it is, the more returns there is to harvest. And yeah.
Yeah, I'd also say as a finishing point, this level system in some ways I think it's a good thing to do to conquer the lower levels before moving higher. That's not always the case. Sometimes you do stumble across like a niche alpha and you can definitely take advantage of that and maximize it as much as possible, right? Maybe it's the first thing you trade. But if it isn't, I would say it's worth going through the sort of beginner levels of risk premiums, optimizing those, getting them more efficient, and then from there you can add other strategy types. That's at least one of the better ways to build a portfolio because, as we were sort of mentioning through this, anything really above level 6, it's they can fade. They can become quite competitive. They can, decrease in returns, whereas risk premiums for the most part are quite stable. They're very resilient, and they most likely will still be working for more years to come. You may have to get even more efficient with them, but they still most likely would work compared to other ones that actually might